So while we're on the subject of timeframes, since we've been talking about timeframes that are representative of good periods, in your opinion, what would be the most ideal way or strategy towards constructing a portfolio of assets? So what would you say? What's the best way to invest in a portfolio?
This is what we learn. This is what we learn.
Just
maybe,
as I said,
yes. It's more than I know that there must be tons of people much cleverer than we are, and I really encourage people to use our Darwin API
of course.
to how you say, to contrast what we are going to say right now.
To possibly contradict us.
No, contradict us,
which would be great.
Yes, it would be amazing.
Yeah, it would be great. Yeah.
But from our perspective, the best portfolio of Darwins is based on Darwins that have a track record of higher than 2-3 years. Mm-hmm. And at the same time, there must be a great momentum on the short term. Phase. So it means that let's filter for those Darwins that have more than 3 years, 4 years, and a certain D-score. It means that it's not only lasting, surviving the market for years. I mean, you need to also to make some returns, not just surviving. No? Yes. So survive and make some returns in the last 4 years, and you use this data set, and for those you invest on those that are having a great momentum. Great momentum means they are winning in the last 6 months, 3 months.
Okay. And is there anything I can use to detect when this changes? If this is no longer the case with the new
instead of using one thing, and this is one thing I recommend for data scientists or
data practitioners
who want to use the data, they don't need to. It's better to focus on the return. Let's say, so if I know that I have a risk of 10% bar, imagine, or I know it's
some curtailed risk.
I know the Darwin has now it's 6.5. Now 6.5 risk is the target risk of the Darwin, and I know it's not going to change because it's a condition of the Darwin. No? It's the target risk is a parameter. It's there. No? So I need to focus on how much return. Instead of using returns, use data scores from 0 to 10 to determine how good a return is. Mm-hmm. Why? Because having a return of 10% is almost as good as having a return of 30% in 3 months. Mm-hmm. But if you work with returns, the difference is really high. It's different.
True. Yes.
So you need to use the normal distribution of how much probability it is to get certain return in 3 months, knowing that the risk is 6.5% in the last 3 for a month. No?
Traditionally, that's what you.
This is the best approach. Not using returns, using percentage of the normal distribution of how difficult it is to reach that return. Mm-hmm. It means that, for example, this example at 30% in 3 months, it's 10, mm-hmm. and 10% would be 9.8. Mm-hmm. So the difference is really small,
minuscule, yes.
But, and it's a much better approach than using the difference between 10 and 30. And this is the way I think people should. It's the best way to measure the momentum.
Okay. And I suppose by taking attributes out of the equation, I'm forced to think about computational expense of the calculation. How is it now compared to what it was before?
Well, when we started doing this one, this is an anecdote. No? Mm-hmm. We launched this was in 2012. It had only 6 attributes, and we launched it, and for certain studies it took. No, the D-score was in 2012. 13 when we started making the code, and we with the first code we lasted more than 1 day for making all the calculation for a strategy with.
That's how expensive it was.
And now it takes us for the worst strategy. Maybe it takes us 3-4 seconds. I don't know how much, but what I mean is
performing a historical evaluation.
But if you calculate it and you consider that you have thousands of strategies, that's a huge computational effort.
Absolutely.
Right now, with the new D-score, it's that easy that we are going to update the D-score each hour.
Okay, compared to what daily was.
And not daily. It will depend. Right now, I think it depends on whenever you trade, and it's always at the end of day. And whenever you trade, if you have investors, it calculates you with more frequency. That if you don't have, those Darwins that are good are more frequently updated
compared to
but never less than 1 hour on average. And this is also a good thing because for a data analyst, if you have data for each hour of the quality of the it's
brilliant.
It's brilliant because and you know that the data you see at that hour is predictive of what happened at that hour, because one thing that happens now, you have the D-score at the end of the day of all Darwins. And this is taking into account all the data at the end of the day. But this data was not available until 2 hours later. So
that's right. So you have some forward bias there.
Yes, there was a forward bias of 2 hours. Now the data you see, it's probably calculated. You know that was calculated 5 seconds later.
Yes.
And this is a huge problem that we suffered in our proprietary investing. Yes. And it's important that and it's also, we need to take this into account as a huge effort, a huge success for the purpose of doing a portfolio of Darwins.